The cryptocurrency market has long been known for its extreme nature, characterized by rapid and sudden price movements. This is known as volatility, which refers to the degree of variation in trading prices over short periods. This phenomenon is at the heart of the trading experience in the crypto world. However, behind the glamour of high profit potential lies a frightening side, the risk of significant losses in a very short period. To understand the reasons behind this instability, we must look deeper than just market sentiment or rumors. We must delve into the technical structure of the market, the effects of high leverage, the behavior of major players, and the impact of global regulations. In doing so, we can answer the fundamental question: why is the crypto market so vulnerable to severe shocks, and why do basic protective mechanisms like circuit breakers, which halt trading temporarily during extreme price changes in traditional stock markets, seem to be largely absent or ineffective in the world of cryptocurrency? Extreme volatility in the cryptocurrency market is not a strange phenomenon arising from market irregularities. Rather, it is the result of complex interactions between several complementary fundamental factors. These factors include low and fragmented liquidity, meaning there is a limited amount of assets available for trade, and the market is split across multiple platforms, strong market sentiment, and the blockchain technology infrastructure itself. The crypto market is still relatively new, having emerged in the last decade, so the mechanisms of price discovery, how prices are determined based on supply and demand, and asset valuation are not yet fully mature. Unlike traditional capital markets, which have a long history, the crypto market is still in the early stages of social and economic experimentation, which makes it structurally less stable. One of the primary causes is the low liquidity in many cryptocurrency assets, particularly altcoins. Liquidity refers to the ease and speed with which an asset can be bought or sold without causing significant price changes. In highly liquid markets such as Bitcoin, BTC, and Ethereum, large trading volumes and narrow bid-ask spreads make the market more stable. However, for most other cryptocurrencies, the number of investors and trading volumes is much lower. This makes the market vulnerable to large price fluctuations due to large orders from a single entity, even if the order is fundamental and not manipulative. When a large order is placed, there are not enough buyers or sellers to absorb the pressure, causing the price to jump or fall immediately. This situation is exacerbated by the fragmented market structure. Assets are not only traded in one place, but spread across thousands of exchanges, which fragments liquidity and makes it difficult to predict. Market sentiment is a very powerful emotional force in the crypto market. News, tweets from influential figures, or even rumors can move prices in a matter of minutes. Psychological factors such as fear of missing out, FOMO, encourage retail investors to buy assets when prices are rising, creating a sudden wave of demand. Conversely, when the market starts to fall, fear triggers panic selling, which exacerbates the decline. Assets most vulnerable to this are stocks that are frequently traded using high-frequency trading, HFT, foreign currencies, Forex during the Asian session, government bonds, and of course, crypto. The crypto market operates 24/7, meaning emotional reactions to news occur throughout the day and night, accelerating cycles of positive and negative sentiment. Additionally, the general public's lack of understanding of blockchain technology leads to overreactions to information, both positive and negative, which increases volatility. Finally, blockchain technology and tokenomics make a unique contribution to volatility. The supply mechanism is determined by protocol rules, such as the mining rate, hash rate, and consensus mechanism. For example, Bitcoin mining requires significant computing power and high energy consumption, which means that the additional production cost of BTC increases as the network difficulty increases. An increase in mining activity, hash rate, can signal an increase in future supply, which can trigger volatility. Mechanisms such as halving, where Bitcoin mining rewards are reduced every 4 years, create expectations of reduced supply, which typically drives bullish trends. However, real-world events can also dramatically affect supply. For example, in 2021, a power outage in Xinjiang, China, reduced Bitcoin's hash rate by 23%, causing one of the largest flash crashes in crypto history. Similarly, high transaction fees and small block sizes can cause network congestion, reducing demand for the asset and contributing to price fluctuations. Therefore, volatility is not just about money, but also about the logistics and network operations underlying it. Behind the statistical data and technical analysis, the crypto market is often controlled by big players, known as crypto whales. Their extensive holdings, often tens of thousands to hundreds of thousands of coins, give them the power to significantly influence market prices. Due to the transparency of the blockchain, large-scale activity from a single wallet can be easily observed by the public, creating a situation where their actions can create momentum that they can take advantage of. For example, a whale might start buying coins in large quantities, causing the price to rise. This attracts the attention of retail traders exposed to the information, who then buy in for fear of missing out, FOMO, pushing the price even higher, allowing the whale to sell their large portfolio at a high profit. However, the influence of whales is not always neutral or limited to trading. There are far more aggressive practices of market manipulation. One example is spoofing, which involves placing and immediately canceling thousands of fake sell orders to create the illusion of high demand in the market. Trader Navinder Saral, for example, allegedly used such algorithms to lure prices down so he could profit from the price difference, and he was charged for his role in the 2010 flash crash. Although the incident occurred in the stock derivatives market, this pattern of manipulation is highly relevant in similar crypto markets. In fact, the Walmart Litecoin incident in September 2021 showed how false rumors can be used to trigger market reactions. Litecoin's price rose 30% after false news of a partnership with Walmart and plummeted after the rumor was denied. Informed traders exploited this inefficiency to profit before the market fully reacted. In more extreme contexts, volatility in the crypto market is often synonymous with the risk of a rug pull. This term describes a scenario in which the founders of a crypto project withdraw all funds collected from investors, usually through a smart contract, and abandon the project without any value. This is a form of outright fraud that is often preceded by intensive marketing efforts to attract retail investors. Luna case is the most dramatic example. The price of Luna tokens plummeted 99% in a matter of days, causing trillions in losses for holders. Although the term trading halt does not officially exist in the crypto market, major exchanges such as Binance, Coinbase, and Kraken engage in a similar practice called market suspension, or trading pause, to protect investors during such extreme volatility. Binance, for example, suspended trading of Luna and UST in May 2022. Rug pulls highlight the most terrifying aspect of the crypto market: the lack of legal protection and clear regulatory authority. In a rug pull scheme, there is no refund process, no investigation, and no perpetrators who can be prosecuted under an established legal system. Investors can only hope to sell before the funds are withdrawn. In addition to manipulation and rug pulls, the phenomenon of stop-loss cascades, or chain liquidations, is an automatic mechanism that exacerbates price declines. When the price of an asset falls sharply, the margin system will trigger forced sales on highly leveraged positions. Traders using 10x leverage, for example, will lose all their capital if the price moves against them by 10%. To minimize losses, they are forced to sell their assets immediately, even if it means accepting very low prices. These mass sales add to the selling pressure in the market, pushing prices down further.